WTI crude is trading around $95 today, Tuesday, March 17th, and Brent is up above $103. The S&P is up modestly on the session, trying to extend a two-day bounce off four-month lows. The VIX sits at nearly 23, gold is holding above 5,000, and on the surface today looks like any other day in a volatile market, but it is not. You've already noticed that I am not David Lynn. My name is Matt Milligan, producer for the David Lynn Report, filling in for David today. 2.5 weeks ago, the United States and Israel began attacking Iran and killing the supreme leader. Iran has now closed the Strait of Hormuz, and immediately after, WTI spiked from $77 to $119 per barrel. The Dow dropped 900 points. Asian markets then fell between 7 and 12% in a week. In response, the IEA released 400 million barrels from emergency reserves, and sanctions on Russian oil imports have been lifted. Over the past several weeks, we have interviewed many experts who have evaluated the energy sector, macroeconomic trends, geopolitics, and technical analysis. What follows are the sharpest, most specific calls they have made about oil, energy, and the subsequent fallout. Here's Josh Young, CIO of Bison Interests, and what happens if the Strait of Hormuz stays shut.
Yeah, I think if this does not resolve soon, we should see all-time high oil prices, and that would be on an inflation-adjusted basis. If you zoomed out even more, you'd see in 2008 we got to about $147 a barrel, and if you inflation adjust that, you're talking potentially 200 plus. And so, historically, cyclicals at the tops of cycles go to their all-time highs.
$200 oil sounds extreme until you look at the mechanics of what is actually happening in the physical market. The Strait of Hormuz carries roughly 1/5 of the world's crude supply. Iran has deployed small boats, sea mines, anti-ship missiles, etc. to shut it down. So far, those efforts are working. Most commercial vessels are stranded. 3 were hit by projectiles in a single morning last week, and the price of crude has been ratcheting upward 5 to 8% per day as the market slowly absorbs the reality that there is no quick fix, diplomatically or militarily. Again, here's Josh Young explaining why.
And so what we're seeing from a price perspective is that every day that this continues, the oil price is ratcheting up 5 to some days right now it's 8%, but ratcheting up about 5% a day. And I think people keep betting on there being some sort of quick fix, and various US government and other officials and economists and so on are calling for various quick solutions, but there isn't a quick solution here other than sort of political victory or concession that reopens the strait.
Rick Rule, founder of Rule Investment Media, recorded with us on March 1st before the strikes began. He warned then that if Iran were hit and responded by threatening Hormuz, the oil market would, in his words, go crazy. Keep in mind, he said this when WTI was still in the low 70s.
If Iran is capable of responding by temporarily shutting down the Straits of Hormuz or threatening to shut down the Straits of Hormuz, the oil quote goes crazy. I mean, crazy. It won't stay there because the Iranians don't have the physical capability to ultimately blockade the Straits of Hormuz. They don't have that capability. But until it's proven that they can't, which will take, 4 weeks, 6 weeks, something like that, over 50% of the world's export crude moves through that 50K strait. And the financial and psychological implications of that before they work themselves out would be tremendous.
Luke Gromen, founder of Forest for the Trees, takes a step further. He argues that the oil spike will force a second crisis in the bond market because oil importing nations that hold U.S. treasuries will have to sell those financial assets to secure physical energy. In other words, you cannot eat a treasury bond, but you cannot fuel a factory with one either.
The world holds treasuries, and the world needs oil and food. And one is on some level being disrupted. And so, is the world going to hold its treasuries and starve itself of food and oil? Or is it going to sell its treasuries to bid up oil and food? And to me, it's not a very difficult question to answer. And so ultimately, the longer this goes on, I think you will see a huge natural buyer of treasuries turn seller.
About 90% of the oil that flows through the Strait of Hormuz is bound for Asia. That means the countries most exposed to this crisis are not in the Middle East. They're in East and Southeast Asia: Korea, Japan, Thailand, India, the Philippines. Louis Gave, CEO of Gavical, has been covering Asian markets for decades. He says the real victims here are America's own allies.
I do think the whole news out of the Middle East is problematic for Asia. When you look at where the oil from the Persian Gulf goes to, whether the oil from Saudi, the oil from Kuwait, the oil from Iran, it mostly goes to Asia. It's like 90% of it goes to Asia. So the idea that the Persian Gulf could stay blocked for weeks, perhaps months, creates legitimate economic challenges for the whole region in a way that, say, it doesn't for the United States. The United States, for all intents and purposes, is energy self-sufficient. You have, the U.S. needs to import some heavy crude and produces too much sweet light crude, but by and large, the U.S. is roughly even on its energy balance. Asia isn't. Now, when you look at Asia, you have countries like China that have built big stockpiles and can probably withstand any interruption in imports for a few months. But this isn't the case of other countries. It's definitely not the case of Korea. It's not the case of Thailand. It's not the case of the Philippines. It's not the case of India.
China is in a different position. Beijing lost access to Venezuelan crude earlier this year when the U.S. seized control of Maduro's government. And now 20% of China's own oil exports flowing through Hormuz are at risk. Shaun Rein, founder of China Market Research Group, argues that China has spent 15 years preparing for exactly this kind of disruption through massive investments in solar, wind, and electric vehicles. Over 50% of new car sales in China last year were EVs. So while China will feel some pain, it may feel less than almost anyone else, according to Shaun.
It's been a slightly tough year, as you said, for China. Starting off, you had a lot of their oil has been disappeared essentially by the Americans. So first, by taking Maduro and Venezuela, China lost 2 to 3% of its oil imports, which is where they get from Venezuela. Now with Japan, it's a bigger hit in Iran. 20% of China's oil needs are imported from Iran through the Straits of Hormuz. But here's the thing, David. There's definitely a hit on the consumer here, definitely hit on manufacturing here because China needs imports of oil. But China over the last 10, 15 years has been trying to lower its dependence and improve its energy security by not buying international oil because they've been investing billions and billions of dollars into solar panel and wind. So for example, China increased about 380 gigahertz of solar technology last year, which is more than the rest of the world combined. China also added, for the 15th straight year in a row, more solar power in the form of wind turbines than the rest of the world with about 280 gigahertz. So yes, China is going to be hit by the devastation and the tension in the Middle East.
Every oil shock invites comparison to 1979, when the Iranian Revolution knocked out one of the world's largest exporters and triggered gas lines across America. Professor Steve Hanke of Johns Hopkins University literally wrote one of the first textbooks on petroleum economics in the late 1960s. He joined us and he said that the comparison is instructive but overstated. The numbers tell us a different story than the headlines. Here's Professor Hanke.
Potential for disruption is lower today than it was then, David. And the reason for that is that Iran in 1978 was producing 8.5% of all the world's oil production. Now they were producing at 5.2%. So that's less of a disruptive factor. The Mideast, 1978, they were producing 34.3% of the world's oil. Now 31. So they're less of a factor than they were. And the U.S. was producing 15.6% of the world's oil in 78, and now we're up to 18.9. So we're less dependent on foreign production than we were then. Another big factor that makes things better now than they were then in 1978, 79 is that the oil intensity, the amount of oil that we use per unit of GDP is declined dramatically from 1.5% down to 0.4%.
So the structural picture is less dire than 1979, but structure and timing are two different things. Retired Marine Lieutenant Colonel Hal Kempfer, a former intelligence director for the 1st Marine Expeditionary Brigade, puts a hard number on the gap between the emergency response and the actual shortfall. As I mentioned, the IEA announced a 400 million barrel coordinated release from strategic reserves, which sounds enormous, but Kempfer says it buys only about 10 days.
I understand everything is at full tilt now. There is no excess capacity anywhere. So that alleviates some, but the question is, okay, what about all the rest? That's where I think that 400 million can make a big difference. I think it can make a big difference for maybe 10 days, 2 weeks, and then we're right back where we were. So it really puts pressure on us to get the Strait of Hormuz back open again.
Not everyone sees $200 oil. In fact, some of the traders we have spoken with are actively betting against it. Todd Bubba Horwitz, founder of BubbaTrading.com, is short crude right now. He argues that the spike is a pure fear premium with no structural staying power. And he points to an important detail that many commentators are overlooking. The forward curve for WTI 1 year out is $69. The futures markets, in other words, is telling you that this price will not last, this high price. Bubba calls potentially the selling opportunity of a lifetime. And here's Bubba with the call.
But WTI at $93, what are you doing with oil first and foremost?
Oh, oil. I'm a seller of oil. I'm short oil, and of course, I was a seller Sunday night when they spiked up to 119. First of all, when you look at a chart from a technical standpoint, you look at a chart. Go back 3 weeks and look at silver when it hit 120. The parabolic direction of this market cannot be sustained. This is purely a fear trade right now, and if you weigh in the true fundamentals of what's going on, only 20% of the world's oils go through the Straits of Hormuz, and none of it's WTI. So if you look out into the future, a year from now, oil is trading at $69. So they're telling you that right now, all you're paying for in oil here is a fear premium. Now, it has a very real effect on the consumer. It brings up higher inflation. It brings in a lot of bad things, but I would not be surprised as soon as this thing resolves out to see oil back in the 70s or 60s. And I think it'll get there rather quickly once we're ready to go. We've seen these type of moves before. And I think the correct side of the oil trade is to the short side. I don't mean just run in and sell it now, but on a big rally, if we get another rally, let's say back to 96, I think that's a great spot to sell it. I think that's kind of where we settled all week after that ridiculous spike up on Sunday night to 119. And again, I think you're going to see this market consolidate, and I think eventually it will break to the downside again.
Chris Vermeulen, chief market strategist at the Technical Traders, sees a similar setup from a charting perspective. He points out that oil's long-term trend was already bearish before the strikes. The 150-day moving average still points down, which means this spike, however dramatic, remains a counter-trend rally within a bear market. News-driven gaps of this kind typically fade unless the underlying fundamentals change permanently. Here's Chris with the call.
When we zoom out on the chart of oil and we just kind of go way back in time, you'll notice that the long-term moving average is green 150-day moving average, which is a great gauge of what the long-term trend is doing. The markets really are still kind of making a series of kind of lower highs overall. The trend is down. This is a counter trend rally kind of within a bear market that oil has been in. And we've just had this big gap, more or less, on news just around it. Now, we kind of had a similar scenario over here in terms of bombs being dropped, and it created a huge spike. And so this is what happens in a bear market. You get some of the strongest rallies, and a lot of times they're triggered by some type of news event, and it creates anybody who's short to start to cover. And of course, this is a big event, and it's created another huge pop in price. So the big question is this just a news driven pop? up into and past resistance, and is it going to fade back down? At this point, I kind of think that's what's going to happen, and I think we'll fall back down into this range. But when you look at it short-term wise, definitely a lot of people today are thinking oil's going to go through the roof. But this type of move is typically a capitulation move. We usually see exhaustion, big gaps, big news kind of hit when prices is pushing to an extreme. And we're seeing this today across the board. This has happened in gold and in the equities markets, which we'll touch on shortly. So at this point, oil is, it's the fear has been worked into it. It might want to rally back up, test those highs today or over the next couple of days. But I think it's going to be very similar. The news is going to fade away and we'll see the fear kind of drop as well.
So where does that leave investors? We have a genuine split amongst our analysis. Some are calling for $200 oil, like Josh Young. Others are shorting it right now, even at like $95, like Bubba Horwitz. One way to cut through disagreement is to step back from the crude price itself and look at the equities underneath it. Danny Moses, one of the traders featured in the movie The Big Short and the book, for his role in the 2008 crisis, has been bullish on energy stocks since before any of this happened. His argument is simple. Energy was the most undervalued, underowned sector in the S&P 500 before a single bomb fell in Iran. The war has changed the catalyst, but it did not change the math. Here's Danny.
I do believe geopolitical risk in general is underpriced in all commodities, gold, and we've already seen the move there, and oil in general. And I felt that the energy sector, separately from anything going on in the Middle East, was undervalued because the belief is that oil was going to go to 45 or 50. Well, if you just told me that West Texas would sit at 60, I mean, look at ExxonMobil, which I've been fairly vocal on and bullish on. They put out a 2030 plan or whatever based on $65 oil. If $65 oil happens, it's the cheapest stock in the S&P 500. And so I was looking at it more from just where oil is without this, because these situations, and we saw already once when we bombed, it was, quick and I wouldn't say painless is probably the wrong word, but it happened rather quickly and it kind of got pushed out at least a couple years. So we might see the same thing here again if there is another attack, but I'm the wrong person to ask that question, but it is another reason to kind of overweight energy stocks and no one is.
10 experts, 2 camps, and 1 historical disruption. The oil bulls see a physical supply crisis with no quick resolution and a price that has barely begun to reflect the danger. Oil bears, on the other hand, see a fear-driven overshoot in a market that still has ample global supply outside the Persian Gulf. Both sides make smart arguments backed by evidence. If the last 3 weeks have taught us anything, it is that certainty about this conflict has been consistently punished by events on the ground. What is not in dispute is that the Strait of Hormuz matters, that Asia is absorbing the worst of the shock, and that energy as a sector has gone from an afterthought at 2.5% of the S&P to the single most important variable in global markets for 2026. We'll continue to follow this story with experts you trust. So comment below with your view. Are you positioned for $200 oil, or are you expecting a collapse back to the 70s? Don't forget to subscribe to our free newsletter for more analysis and our new Clips channel on YouTube. Links are in the description. I'm Matt Milligan. Thank you for watching.